talk to me about your mindset when you're looking at a property as to what you think the best thing is to do with that property. And also, how did things change for you after you sold your first property in terms of your relationship with investors?
Yeah, great question. So Clint, the way I look at this is you got to look at your cost of capital. Okay. So yes, self-storage is a great long-term hold asset, but the capital you have underneath it, the ones that you use to get through the value, we're not buying stabilized deals. You and us, we're not some money bags, life insurance companies that's just buying 4 caps because it's more stable than investing in the stock market. So when you go out and you buy a value add deal or an expansion, conversion, ground up development, the investors in the debt that you initially place on that type of asset is not the investors in the debt that you want on a long-term hold strategy, right? Typically, if you got a value add or some type of construction on the debt side, you're looking at floating rates. So now you got risk from an interest rate perspective. And then the investors that go into those types of deals, they're looking for, double digit returns. They're looking for, anywhere between mid teens all the way up to low 20s, depending on the risk of the project. Those type of IRR numbers are not sustainable for a long-term hold. So you have 2 options. You can either refinance into some permanent debt, like say a 10-year CMBS loan or even longer term life insurance loan. And then the equity that you have on that, if you still need to retain equity, you need to move more towards like the coupon clipper style investors. These are like going to be your DST investors that they ran out of time on their 1041 or 1031. They're okay clipping a 6% coupon per year because it saved them 30% in taxes. That's the type of investor. With that being said, my strategy is we don't really have any long-term hold deals with investors. What I do is I do the forced appreciation play, whether it's any of those strategies, and then typically sell those to realize that equity so that I can eventually go off and buy self-storage facilities with no investors and just debt, or ideally, once I'm, old and tired and I don't even want to deal with that side, just all cash, no debt, no equity, and just truly just treat it like a cash cow piggy bank, right? And the reason you look at that is if you look at, are you guys familiar with like the Laffer curve or the curve of diminishing returns, right? When you look at a deal, especially when you're analyzing it from an IRR basis, internal rate of return, because that's a time-based value system, you see that after, typically on self-storage deals, after about 3 years on a value add or a small expansion, or up to 5 years on a conversion or ground up development, every additional year that you hold that asset, that return that you're getting is actually much lower than the opportunity cost of taking the equity and investing it into a new value add project where you can push, on a ground up deal, you build it for 10 million and in 3 to 5 years, it's worth 18. On a stabilized deal, you buy it for 10 million and then in 3 to 5 years, it's worth 12 million. Maybe, right? Whatever inflation rate is, I guess. So it just doesn't make sense right now to build a cash flowing long-term portfolio for me and the investors that I currently have access to.